Nifty look good. And Jayakumar joins us, Managing Director with Prime Securities. Jakes, not 1 month ago, not 3 months ago, from last 3 years, value proponent like yours have been making a case that, guys, it's time to start taking some risk. Come out of the shelter of good governance, good return ratios. But those arguments of buying into cyclicals or other stocks which offer deep value and some degree of valuation comfort, those arguments have not made money. Are we there that now you should genuinely move out of these haloed stocks?
I think thanks for having me over here. But I think the first point really is that I don't think the idea is to junk governance and say get into non-governance as a contra call. I think the fact that smaller companies, you must go back to the SEBI directive that we talked about, where the concentration of portfolios became in the top 100 and the top 250, depending on whether the
classification was changed.
That's right, the classification. So what that essentially meant was that the big became bigger as far as market caps. It also suited the disproportionate rise of stocks like the 60-70 PE stocks, which in any case had low floats. They had, I would call, career investors, people who had held levers and Nestle for years, never thought it necessary to sell. And especially for those who believe that you must stay invested in the markets, this became a better proxy than pulling out and putting money in anything else, because most of these investors have remained investors right through. So what essentially has meant is that the incremental demand was disproportionate to the thing, and the stocks kept rising, and to the supply, as it were, and the stocks kept rising. Many of these stocks have had no new issuances. They've had new investors and new money getting allocated more and more repeatedly. So to create a bubble-like situation today, in fact, why bubble-like? I think it's a bubble situation compared to anything else in the world. So you could argue at what point is the inflection point. Now, we've been arguing at least for 6 months now that it's time to move out of the shelter of this thing, because the markets are actually expanding upwards. And we did make a brave call that 10,600 was bought in fact on your show, and said that you have nothing to lose except if fixed deposit rates, go out there and invest right now. And I think that's the way it's turned out. And if you see the disproportionate returns given to you by some of the mid-caps in the turnaround has been high. I mean, a large private bank, which till recently, people are talking about bankruptcy pricing across the board in NBFCs and private sector banks, have given from their bottoms over 100% returns.
What is become 72 to 4 years bank? If
well, I don't want to, we are conflicted in some sense, but yeah, that's a classic case.
Where something like RBL also. From the result of just mentioning it in the morning.
Bank, all these have actually given. So the thesis actually is much more than just branching out into smaller stocks. The thesis is that there are times in life where the markets tend to be excessively positioned on one side, which means either in terms of an index where people felt that the bottom is going to fall out. And you remember at that time we did talk about, and this was exactly 2.5 months ago, I remember on your show, we said the markets bottom out 6 months ahead of the economy. So the economy is darkest before dawn. And really the latest readings of the economy have been really, really bleak. But I'm still going out there and saying, as I did say 3 months ago, that come January, which is approximately 6 months after the bottom was formed, you'll start seeing economic numbers. What will create it? No idea. Is it so very obvious that the markets are telling you that the economy is going to bottom out somewhere December, Jan, February, around that time?
What if markets get it wrong? What it's, we look back and say, look, guys, this is all liquidity. It's all global allocation. It's all what happened with emerging markets and, what transpired because of the interplay at emerging markets. We got flows and we got lucky.
So there's a flip side to it. The economy got killed because of liquidity. Yeah. Bring back liquidity to the economy. The entire thing has been, how do you transmit money? And I think the government, in all fairness, has had the right intent. Maybe not the right implementation at times, because they're also sort of grappling with what exactly to do, how to transmit. I think the word transmission has been used more often by a finance minister in the first 6-8 months than I've ever seen in the history of this country. The word transmission. Rates are being cut by the RBI, not transmitted enough. RBI has talked about transmission, everybody is. And it's coming out at a time when the corporate cleanup has never been more aggressive or more ground up than it's been right now. So given those two, it will take time for the money to transmit. But I think I've been tweeting about this, that the real estate space and the NBFC space need these are the only two spaces. Believe me, if you had a choice of just two spaces, unequivocally, the two spaces will be these two that you need to address. Why? Because the NBFC gets credit back into the system. The real estate space actually starts monetizing the oldest asset as far as any Indian is concerned. It's an asset
and
where
it has a great multiplier effect on the economy, jobs, infrastructure.
it absolutely does. And I think the latest steps taken, I think are literally, I mean, we tweeted about it about 2 weeks saying this exactly. So other than the stamp duty cut, virtually everything else that's been talked about has actually come through. All we want now, and this, by the way, is very different from the past because of three things. One, there's an amount talked about. Two, the cast of characters has been given. And C, it's largely a set of people who got independent charge. This is not going to be monitored by RBI. It's an AIF structure. And investors will come in. In a sense, you start the process with, let's say, SBI, LIC, etc., putting in 500,000 crores each. Any number of overseas funds are there, ready to give last mile financing. And I think people still don't understand this. This is not equity financing. This is priority financing, which will get paid off first. But importantly, projects will get completed and ghost towns will start looking like completed.
And the fisc is not getting compromised. I'm
sorry?
looking at 75,000. If I recall our last time's conversation, you said, look, the fiscal deficit number is more like an holy grail number. That's a sacrosanct number which should not be compromised. A corporate tax cut has happened and government has not compromised on that. But despite their admission, acknowledgement and communication that, look, fiscal deficit will not be compromised, Moody comes out and says, we think there is a problem in the economy. So it's very discouraging. Because if rating agencies, they start taking a negative view, it automatically defeats the whole purpose of protecting the fiscal, because then your bond yields goes higher and cost of capital does not go wrong.
I don't want to participate in an echo chamber that starts lashing out at rating agencies, because they're not here to defend their actions. I mean, they've done their own analysis. So let's for a moment say, I don't think rating agencies really historically have got it completely right. They have, on various occasions, probably got it right. My own assessment this time is they've got one set of assessments is static and it's kind of dated. It's looking at, so I'm not particularly a great fan of taking that as a projection of things going on. I think here what is important is, in a time when there are, I would say, event-wise discontinuities in the system, which means that a person whose rating has been downgraded does not immediately get money. New paradigm in the Indian markets. Two, in the past you would say that HDFC as a AAA would borrow at X particular rate. Somebody with a AA plus would borrow at so-and-so rate. Even a BBB would get money, but at a different rate. That particular paradigm is breaking for the moment. Until it comes back. So I don't think you can use empirical data to say. I think what you can say is that liquidity finally is the panacea for this. In what manner, shape or form will liquidity trickle in? And that's why, if you remember, we gave a very interesting thing. Overseas equity in domestic debt. That's the marriage you need. This is the marriage that, no constitution has said no to. And this is the marriage you actually need, to be sitting and making things happen. Which means whether it's a private sector bank that attracts a lot of money, whether it's family office money, whether it is private investor money, whether it's fund money, when married to domestic debt. And by the way, our own sort of in a particular private sector bank case where we are working on raising money, the kind of alternative, these investors do not exist today.
Yeah.
That's the kind of investors that are coming in. Because world over, when banks need money, banks and financial services are the highest in terms of attracting capital. And a lot of money, by the way, there's an investor who's actually come out and said, treat me as dumb money. I just want to play. So I don't need any conditions. I don't need any board seats. I don't need nothing. I just need something in an RBI approved limit. 5% if it is, so be it. So there are different kinds of investors coming. So the traditional PE investors typically come with diligence and conditions, etc. So we are seeing a new category of investors.
Family offices is what we are looking at investing in Yes Bank. I mean, Nantara, my colleague Jake's pretty much echoing the same point, that the Munjal and the Mittals are looking at putting money in Yes Bank.
I think some of the finest Indian investors, including family offices, are looking at investing. I mean, see, whether it's Yes Bank or it's any other bank, I'm just saying, again, without being specific about, I think the concept of new investors coming in from across the world into the Indian financial services. Today, this morning, I read something about NBFC getting money into a particular part of another NBFC. So, one part is getting financing. So, I think it's overseas capital and domestic debt. And if you take this theme forward, whether it's completion financing for real estate, all of these themes will play out.
We've completely run out of time, Jakes. But thank you so much for joining us.
Thank you.
Always great, getting a sense of, what's brewing there.